Okay. Let me just tell you a little bit about myself and then asset preservation. As my name is Dino Champagne. I am the division manager with asset preservation. Asset preservation is a national 1031 qualified intermediary. This is all we do. We 1031 accommodator. I have been with asset preservation since 2002. Prior to joining asset preservation, I spent 14 years as a commercial broker and 14 years as a banker. Here's your eyesight test for the day. I started when I was 2. Okay, I feel safe leaving the parking lot now. You all can see. All right, how many of you have clients that currently you work with doing 1031s? A few of you. Okay, what I'm going to take you through, I can talk on this subject, by the way, for probably 8 hours and never get bored. Don't worry, your mother's told me, listen, you're not punished, you're okay. But we have a short period of time, so I'm going to go through the basics of a 1031 tax-deferred exchange. Now, I want to make sure I'm hitting this thing right, so I'm not going... I've got it right. I've got the right arrow. Perfect. What I'm going to cover this evening is going to be capital gain and taxes. All right, very important for you to understand what the capital gain tax rates are and then how that works in a 1031 and how you calculate the gain. We're going to talk about if somebody sold a property, the difference if they sell and buy or if they exchange. We're going to talk about the IRC Section 1031 and their exceptions. There are certain rules that investors have to comply with when they're doing an exchange, okay? We're going to talk about what's like-kind property. I can't tell you how many times I get that question and people think what like-kind is and they are off the mark a lot of times. There's certain dollar amounts that you have to comply with when you do a 1031. We call that the exchange equation. And then the next thing we're going to go through is the process of the exchange, the identification rules. We're going to talk about recent developments, and we're going to talk about the threats of a 1031 because that is being threatened right now through Congress, okay? So, are you ready? All right. First thing we're going to talk about is what are the tax rates that an investor faces today? All right. When you own investment real estate, you have the opportunity to depreciate your property, okay? When you depreciate the property, that is a non-cash expense that lowers your real estate taxable income. So while you're lowering your real estate taxable income, the IRS makes you account for that when you go to sell the property. That has its own tax rate, and that rate is 25%. Okay, so recapture depreciation, 25%. I see my slides got switched up a little bit. It's number 3. It should have been number 1, but it's number 3. Now, the next thing people have to deal with is capital gain rate. Now, I had a call this afternoon that says, what am I going to pay in capital gain taxes if I sell a property? Well, after 2013, somebody said a lot. After 2013, there was a change in the rates. Okay, 2012, I should say, there was a change in the rates. Capital gain rates could either be 15% or it can be 20%. 15% is for those taxpayers that earn, single taxpayer that earns $400,000 or less, $450,000 or less if they're a married taxpayer. Anything above that will be taxed at 20%. Okay, so 15% or 20%. Here's the thing that people don't understand. If you have an income of a certain dollar amount and you sell a property that might have a $300,000 gain, that could trip you into the higher tax bracket. So it's very, very important when you're considering doing an exchange that you also consult your tax advisor. Okay, for all the real estate professionals in the room, should they be consulting their tax advisor? Yes, all right. Now, there's the Obamacare, the Affordable Care Act. It's also called the net investment income tax. That's an additional tax that investors are going to be subject to when they sell investment property. If their income, single taxpayer, is more than $200,000, married taxpayer, $250,000. Okay? If their income is $200,000 or more, single, $250,000 or more, there's an additional 3.8%. And let us not forget about the state of California. Everybody seems to forget the state when they go to calculate tax, okay? The state of California, by the way, does not have capital gain rates. It's just ordinary income. Remember Proposition 30? How many of you remember Proposition 30? No one? That's when the state of California voted itself a tax increase, retroactive to that year. So if somebody did a transaction in the beginning of 2012, when they voted to Proposition 30 in November, It went back to 2012. They made decisions off of what the tax rates were then, only to be surprised that it was increased retroactively. Now, the state of California rates range 9.3 all the way up to 13.3. So those are the tax rates that an investor is faced with when they sell a property. Now, so is everybody with me? Do you see why the dollar sign is all shocked? Okay. Are you feeling like the 1% now? Okay. Now, when we talk about doing a 1031 exchange, and this is mainly for the agents in the room here, it's very important for you to understand how to calculate gain, okay? Because you're going to give your clients some guidance as to what the capital gain might be, and then you're going to send them to their tax advisor so they can go ahead and confirm those numbers. Now, so let's talk about right now how you calculate gain, and then I'm going to show you the difference between somebody selling, paying the taxes and buying, and somebody doing an exchange. All right. By the way, if anybody wants these slides, just let me know. I'll be more than happy to get them over to you. Okay, how do you calculate gain? The first thing you're going to determine is what did I pay for the property? So what is my net adjusted basis in the property? In this example here, we're saying I paid $500,000 for that property. For the investors in the room, when you have property and you make capital improvements to that property, that cannot be written off the year that you pay the expenses. It gets added to the basis in the property when you go to sell. So make sure you save your receipts, okay? Because you're going to need it when you're calculating your gain. If I made an capital improvement to a property to the tune of $50,000, I'm going to add that to the basis in the property. Now remember I told you the depreciation is a non-cash expense that lowers the investor's real estate taxable income. You have to account for that when you sell the property. There's a thing called allowed or allowable, which means if you don't account for it, the IRS could care less. You have to account for it now. That lowers the taxpayer's basis in the property. Now, if you have residential income, the term for depreciation is 27.5 years. For a commercial building, it's 39 years. Straight line, okay? That all got changed in '86. It's all straight line now. So I have to subtract that. So for my example here, I'm saying that the depreciation over the years of ownership equals $150,000. Now for my first segment, what I'm trying to do is figure out what's my net adjusted basis. So I paid $500,000 for it. I had $50,000 worth of capital improvements, and I have to subtract $150,000 for the depreciation. My net adjusted basis is $400,000. Now I'm going to calculate my capital gain. So I sell the property for $1.2 million. I am going to subtract my net adjusted basis of $400,000. I am going to subtract my closing costs, such as title, commission, and escrow, and we'll say that's $80,000. My gain on the sale of this property, as my example, is $720,000. Now, does anybody see loans in that second section there? Does anybody see loans? I had a discussion with a guy today, kept saying, but my loan is this. What is a loan but money that somebody else gave you to buy the property, right? Okay, loans have absolutely nothing to do with gain, and I can't tell you how many times people think that's the reality. Okay, nothing to do with gain. All right, so if you can see, the gain on this property here is $720,000. Now, let's look at the tax ramifications if I'm going to pay the tax. Okay, when you have depreciation, as I told you, it has to be recaptured at 25%. So at 25% of $150,000, that's going to come to $37,500. Then we're going to calculate what's my capital gain. Now the good news is I'm subtracting the 150 from the 720, and that 570 is what gets calculated for the capital gain. So we're making the assumption here based on these figures that this particular taxpayer is in the 20% tax bracket, okay? Their capital gain tax is going to be $114,000. Now, because they're going to probably qualify to have to pay for the Affordable Care Act of 3.8%, that's going to be an additional $27,300. And then figuring that this particular taxpayer is in the 11.3% tax brackets for California, that's another additional $81,380. So, this particular seller of this property is subject to potentially $260,000 of taxes. Go ahead, you can all say it. Wow. But Washington thinks it's only the Donald Trumps that benefit, okay? All right. Now, let's get into a transaction, because this is just calculating the gain. So let's look at the real numbers now. All right, I go into escrow. I've got my $1.2 million as sale price. I'm going to pay my closing costs of $80,000. That lender wants their money back, right? If you have a loan, you have to pay the loan off, do you not? So that money is going to front. Any lenders in the room, by the way? No lenders in the room? Okay. All right. That money's going to friendly lender. So if my loan on the property is $500,000, that's being whisked away. So the cash that me, as an investor, is going to realize at the close of escrow is going to be $620,000. Of that $620,000, I'm going to have to earmark $260,000 to pay Uncle Jerry and Uncle Sam. So if I take that $260,000 and I put it aside, knowing that I only end up without I'm rounding up, by the way, I have $360,000 of cash to go put down on my next property. At a 65% loan to value, my purchasing power is $1 million. Okay, because I had to take $260,000 and give it to the government. So that money is never going to be used by me again. Okay, so my purchasing power is only $1 million. Now, here's the beauty of the exchange. When someone does a 1031 tax deferred exchange, and note the word deferred, I'm never going to say free, because there's nothing free about it. It's deferral, okay? And some investors will use this vehicle as a term to build their estate. Okay, as Mark was talking about, there's stocks and there's real estate. Well, you blend the portfolios, but people will build their estate in real estate. So they can exchange, and when they pass on, they can give the property to their heirs. Okay? When they give the property to their heirs, do the heirs have to pay the tax that they've been deferring? Say no. It's forgiven. Shh. They're listening in D.C. Oh, no, they're on recess. Okay. It's under current tax law, it's forgiven. The heirs get the property at a step-up in basis. Okay, now that's going to calculate into the what? The estate tax issue. And right now with the estate tax, I think it's $5.3 million, I'm rounding up. That is going to be tax-free to the heirs. Anything above that's going to get taxed at 45%. Okay, so while you don't have to pay the capital gain tax that the party that departed didn't pay, you're going to have a step up in basis, which is going to increase the estate and therefore potentially estate taxes. All right, so the beauty of that is that some people use this particular vehicle as an estate planning mechanism. Now, let's say that the agents here have sat down and explained to the client, this is the power of an exchange, and that's why we call it the power of exchange at Asset Preservation, because it's powerful. If I do not have to give $260,000 to Uncle Jerry and Uncle Sam, that means I have $620,000 that I can use to go put down on a piece of property. Same loan to value, 65%. Now I can buy a property for the tune of $1.8 million. Do you see the power of an exchange? The deferring of that tax has no implication tax-wise at all. I'm deferring. Okay, at some point in time or any time I can decide to pay the tax, or I can again just let it ride till I die. Okay, but I am using the government's money to buy more. To buy more. That's the power of an exchange. This is why it's so important for investors to understand that this is a vehicle that you can use to grow your portfolios. Okay, not only for an estate planning, but also you can diversify, you can consolidate. All right, you can do a lot of things with this, and we're going to talk about like-kind in a minute. All right, so do you see how powerful this is? Now, the government says, yes, taxpayer, you can avoid paying me right now, but there are certain rules you're going to have to follow in order for that to happen. Okay, so there are rules and there are guidelines. So let's talk about those. Here's what the code says. Let's see if I can say this right. You ready? No gain or loss shall be recognized in exchange of property held for productive use in a trade or business or for investment. Such property exchanged solely for like-kind property do be held for productive use in a trade or business or for investment. Thank you very much. Okay. That's one sentence, no commas, no semicolons. It's written by attorney. That's why they're billable by the syllable. Here we go. Let's break this down. It says, no gain or loss shall be recognized. As I've already mentioned, it is a tax deferral mechanism. It's not a tax-free mechanism. Okay, on the exchange of property, so there must be an exchange that takes place. There must be an exchange. The property that I'm exchanging must be property that I'm holding for trade or business or for investment. Okay, we're going to talk about holding periods because I'm sure you guys are thinking, well, how long do you have to hold? Okay, we're going to talk about that. Now, the property must be exchanged solely for like-kind property. There are certain properties that qualify, and there are certain ones that do not. Okay? There's personal property exchanges, and there are real property exchanges. Okay? But there must be like-kind. And the property that I'm exchanging into must also be property that I intend to hold for trade or business or for investment. So as you can see, it has to balance on both sides of the equation. Okay? So that's part of the rules. Now, the IRS giveth and the IRS taketh away. Let's talk about what does not qualify. Stock and trade or other property primarily held for sale. How many of you were working with clients that were buying REOs and short sales, fixing them and flipping them, okay? That does not qualify for a 1031 because the intent of the taxpayer is not to hold, it is to sell, okay? It is to sell. So if I'm a flipper, okay, or I'm a developer, I don't qualify for the 1031 because that's considered inventory and therefore non-like kind, okay? Other things, stocks, bonds, and notes, not exchangeable. Securities or evidence of indebtedness or interest. All right, everyone ever see seller financing coming back? Anybody seeing seller financing coming back? Okay. I've got a transaction right now where there's seller financing involved. They're selling for about $1.2 million. The seller's going to carry back about $200,000. If the seller takes that note at the closing, so in other words, the seller is the beneficiary of that note, the beneficiary being the lender, if you will, okay? And that note is, say, a 5-year note. And it's interest only, we'll just pretend. And when that note comes due in 5 years, he comes up to me and says, okay, now, that $200,000 note that I took, I want to exchange that now, because it came from real property, right? Not anymore. Once you touch the note, it becomes personal property and therefore non-like kind in an exchange. Okay, there's ways of working with a note in an exchange. We're not going to cover that today, okay? But once the taxpayer touches the note, it's never going to be a part of an exchange again, ever, all right? Interest in a partnership. I'm going to touch on this, and generally in this class, when I do this particular presentation, I don't spend a lot of time on partnerships, but I'm going to have to tell you that has been the call for the last 48 hours for me. You ever have a day where, or 2 days where it's the same question over and over and over again? Okay. Here's the thing that's very important, and how many of you as real estate professionals, clients will ask you, and those are clients in the room, go, what's the best way that I should take title to a property? Or if I want to join with other people to buy a property together, should we form a partnership? What should we do? And the one thing that people seem to lack is asking the exit strategy. What do I do when I'm ready to sell this property? Okay, so people go in together and they form a partnership. And now they're going to sell the property. If the partnership itself wants to do an exchange, there's absolutely no problem there. The problem is when Manny, Mo, and Jack, who are the partnership members that have the interest in the partnership, no longer want to be together. And they're sitting in escrow. And now they find out, they call their accommodator, and their accommodator says, sorry, your partnership interest is non-like kind to fee. It's clearly in the code that you cannot exchange membership interest under 1031 2AD, I believe, because I've typed it enough time in emails for the last, I think I've got it right. Okay, but the membership interest is non-like kind. It's prohibited. It's prohibited from being exchanged. Now, here's what I want to caution you about. If they drop out of that partnership under a subchapter case 761 drop down, okay, so they decide, I'm going to sit in escrow, and I'm just going to have them just change it, right? So they call the title company, and they say, just change the deed, right? You get those calls? all the time. Nothing's happened, I've just changed the deed. Just paperwork. Okay, so we're dropping down from the partnership, and now we're holding title as Manny, Mo, and Jack, tenants in common. And they sell the property, and they go their separate ways and do an exchange. Here is the linchpin that's going to fail in the state of California. What was Manny, Mo, and Jack's intent? To sell by virtue of where they are and what they've just done. Because you see, who was the taxpayer that owned the property all those years? The partnership. Now you have Manny, Mo, and Jack. When you do an exchange, there's a form that the taxpayer fills out. It's called an 8824 form. And on the 8824 form, it says, how long have you owned the property? And I saw date, month, and year, not minutes, seconds, and hours, okay? And there is the problem, and the Franchise Tax Board is auditing this. And I had a call yesterday, and the guy was going, I heard this, and I wanted to confirm this with you. And he's going, they're trying to drop out of a partnership. And I said, here's your problem. With the federal government, under the IRS, you might be able to pass the test. But the Franchise Tax Board is not taking the same position. And I talked to a client about 30 minutes ago who's currently being audited by the Franchise Tax Board for their 2011 tax return for that very thing. So all I can say is, as real estate professionals working with clients, when you're looking at these profiles, okay, or you're getting the prelims and you're seeing title on there, okay, and you're seeing it's being held as a partnership, and then all of a sudden your clients want to drop out of it, where are you going to send them? To their tax advisor very, very fast, because it's a highly risky transaction with the state of California, okay? So I just wanted to make that, pretty clear. All right, certificates of trust, beneficial interest, I already covered that, choses in action. Those things do not qualify for a 1031. So is everybody good so far? Am I boring you? Not yet? Okay, good news. All right, so the $64,000 question, how long am I supposed to hold the property for it to be considered held for investment? Well, there's no limit, there's nothing addressed in the code that says you must hold it for X period of time. Some tax advisors might say 1 year because it covers 2 tax returns, and when we have an asset that's more than a year, we get what? Long-term capital gain treatment. So 1 year might be considered sufficient. Some may say 24 months because the 24-month period seasons it a lot longer, okay? Now, there was also a revenue procedure, 2008-16, which addressed vacation homes. In that vacation home, it says if you want to do an exchange with the vacation home, in order for you to season this as an investment, you're going to have to rent it out for 24 months. And it used the term dwelling unit. And so some are taking that term dwelling unit to apply to 2 years is probably going to be a sufficient period, okay? Now, there's a couple of court cases that I'm going to address, but there's one that's not in the slides, but I'm going to talk about. And that's why you can't just hang your hat on 2 years. There was a case that recently came out in 2014. It was the Allen case. This particular individual held the property for more than 12 years. But they were a developer, and they planned on developing the property. And they were trying to JV it to get some people to help them out with it. They hung on to the property. The guy never changed the intent for that property to be a developed property. He went ahead and did an exchange, and his exchange failed. So time is one issue. It's not the only issue that you have to concern yourself with, okay? But definitely short holding periods can be a problem. Now, when we talk about the intent to hold, what was the purpose of the acquisition? Why did you buy this property? Were you planning on fixing it and flipping it, or were you planning on holding it? How many have you done in a year? Okay, so there's a lot of facts and circumstances that they might come into. Did you put this property on the market for sale? Did you try to rent out this property? You have to tell a story, and it should never start with once upon a time, okay? Not good. Now, there's a couple of cases, the Goolsby case and the Reesing case. All the time people go, well, if I want to exchange into a property and I want to turn that property into my primary residence, anyone ever get that question? Can I exchange my investment property for my primary residence? What is the answer to that? No, because a primary residence, while to the taxpayer may seem like an investment, it is not taxed as an investment. It's treated differently. It's a completely different tax code. So you cannot exchange your property and move into the property right away and call it your primary residence. That will not qualify for an exchange. Now, in the Goolsby case, that's exactly what they did. They exchanged into a property, and within 2 months, they moved into this property. They were working on a basement and such they had going on. The HOA prohibited the property from ever being rented. So that's kind of a, you know, is everybody feeling the ground crack beneath their feet? Okay, they lost in this case. They moved in it in 2 months. Their intent truly was never to rent out the property by their actions and their activities. Now, in the Resync case, they ended up having to move into the property, I think it was like 8 months after acquiring it. The Resync case, they tried to rent out the property for 6 months. They had some applications. There were a lot of facts and circumstances that surrounded that transaction that now made it that they had to move into it because they could no longer have it rented out, okay, because it was taking forever and they had some family issues that were going up and back. Actually, their exchange was upheld. So theirs was upheld. So time is only one factor when we talk about primary residence and 1031s, okay? Now, there are times where the two tax codes actually make sense, all right, and they kind of work together. All right, we're going to talk a little bit. That slide's a little bit farther back. I'll get to that one in a second. Oh, the next thing I want to go into is when we talk about exchanges, remember I talked about there's certain rules, right? How many of you have ever heard that if you have an accommodator, that if you sell a property, escrow holds the funds, wires it to the next closing, you're good? Anybody ever hear that happen? I didn't touch the money, right? I'm the tax, I sold, I didn't touch. Me, no touching. Escrow had it. Escrow wired it to the next escrow. We're good. No, you're not. In an exchange, it is required that the qualified intermediary becomes the seller of the relinquished property and the buyer of the replacement property. Our documents are the linchpin to the success of any exchange. Without a qualified intermediary, you have what the Crandalls have, a taxable event, because the taxpayer cannot have actual and or constructive receipt of the exchange proceeds. Okay? Everybody follow me on that? You must have a qualified intermediary for it to be a valid exchange. You cannot just have escrow wire from one closing to the other, even if you're closing simultaneously. The only time that you do not need a qualified intermediary is when there's a direct swap. Okay, when buyer and sellers want each other's property, you do not have to have a qualified intermediary. And there's another time when you don't need a qualified intermediary, that's when there's eminent domain and you fall into IRC section 1033. Okay? All right. So, in this particular case here, they had their closing agent in Arizona wire to the closing agent in California thinking they were good to go. No, they're not. And they ended up with a taxable event. So, do you need a qualified intermediary? So, agents in the room, when your client says we don't need a qualified intermediary, are you going to document your files? Yes. Okay, you have to have a qualified intermediary for the exchange. Okay. Now, we talked about like kind. When you're doing a 1031, it has to be like kind. Now, sometimes people get all caught up on the type of product that it is. If I am selling a single-family rental, do I have to buy a single-family rental? No. I can buy an apartment building. I can go from raw land to an office building. I can go from a jack-in-the-box to an industrial building. Okay? Here's the key. Real estate for real estate. There was time when I was in a transaction, I was visiting an office, and they said, well, my client's got land. They're not all that excited about selling the land because they got to go out and buy more land, and he doesn't want to buy land. I said, how long have you had that listing? A long time, okay? I said, do you realize that your client does not have to buy land? And he didn't realize that. So do you think that kind of opened up some options? So this is where, as real estate professionals, it's important for you to understand that, you know, you have to explain to your client, there are more options than what you think. Maybe they're tired of dealing with the tenants, the toilets, the trash, the termites, and the taxes and such. Maybe they go into another product where it's a Delaware statutory trust where there's going to be no management. Okay, there are a lot of products that you can go out there. What you cannot go into, by the way, is a REIT. You cannot exchange your fee for a real estate investment trust Why is that? Because a REIT is a partnership, and that's membership interest, and it does not qualify. Okay, do REITs do exchanges? Yes, they do exchanges, but not the members of the REIT, okay? So you cannot exchange into a REIT even though it's real property. So is everybody clear? Like kind is very, very broad. He asked if a TIC, which means tenant in common, is not eligible for exchange. No, it is eligible. Yes, under Revenue Procedure 2002-22, and then there's another revenue procedure that covers the Delaware Statutory Trust. The reason you don't see TICs anymore is because of the lending. Because when you had tenant in common and everybody was coming through town selling tenant in common, okay? So for those of you that may not be familiar with what he's talking about, it's when somebody wants to be management free. So they're going into like the Westfield Mall, if you will, where you're getting an undivided fractional interest of a larger project. But you have no management control, so you have to be really careful on that because you're stuck. But you can only have 35 tenant in common owners a part of that. Well, they all had loans. Try to get a loan today on a tenant in common, almost impossible. That's why they're all doing Delaware Statutory Trust, which is a beneficial interest but still qualifies for a 1031. Okay? So does that answer your question? Yeah.
Yeah, I just wanted to comment on this like kind. Not all accountants understand what you just mentioned. I've gone probably almost half, 40% of the accountants will give you misinformation about what like kind is definition.
For those that didn't hear, Mark was saying that not all accountants understand what like kind means. And you know what? You're right. Because in an email I had today, the accountant said that they can exchange their interest in a partnership. So hopefully the accountants will at least talk to a qualified intermediary that's, specializes in this. I can point them in the right direction and show them the code that, yes, you can qualify, but that's very right. So it's important that when you're working with investors and investors themselves, have accountants or tax advisors that understand real estate. Because not every tax advisor understands real estate. Okay? Very different animal than maybe manufacturing. Okay? So. All right, okay, so now, as I said, there's certain rules that you have to comply with. Remember we went through the slides of calculating gain. Okay, we had this huge gain of $720,000, right? The minute you know that number, that's going to tell you whether you're going to do an exchange or not. Okay? Now you can take that number and you can put it away because it's no longer going to apply to what's going to go forward in an exchange. The IRS says, and I have to tell you, there's a lot of times when people come up to me and go, well, isn't it just the gain? Or isn't it just the cash coming out? And the answer to that is no. In order to defer 100% of the gain, your target purchase price is going to be to reinvest all of your cash and to replace all of your debt on the property. So in other words, you're buying equal to or greater than what you sold for net closing cost. So if I'm selling for $900,000 and I've got a $300,000 loan with $60,000 worth of closing costs, I've got basically $540,000 worth of cash. I go out and I buy a piece of property for $1.2 million. I'm getting a loan of $660,000. I'm putting my full $540,000 into the property. I have basically met my exchange. I have no boot. And if you're not familiar with the term, when you talk to an accommodator, you'll hear the word boot. And I don't mean the shoe sale at Nordstrom, okay? In my world, boot means taxable. So in this particular case here, they have spent all their money and they bought equal to or greater than. Now, for the real estate professionals here, it's something to be aware of. A lot of times people say, I'm going to sell a property for, $900,000 and I'm going to buy a property for $900,000. You're deferring the tax, but you're not helping yourself, especially if you've owned the property for a very long period of time. And the reason I bring that up is because this is the analysis that real estate professionals have to show their clients. When you do an exchange, the basis in the property you sold comes with you to the property you're buying. And if I've owned a property for 30 years and my depreciation is over, and I buy another property for $900,000, I have no more depreciation. Isn't depreciation a good thing for an investor? Yes. So in order for me to get more depreciation, I have to buy more. And it's the difference between the two that'll give me a new depreciation schedule. okay? So just keep that in the back of your head. I usually do that more in an advanced class. All right, now, if somebody sells for $900,000 and they buy for $700,000, that automatically tells me there's going to be a boot issue. Okay, there's going to be a taxable event. Whether it's going to be mortgage boot or cash boot, I don't know. But in this particular example, they got a loan for $260,000. They put $440,000 down. So they had $100,000 of cash boot, and they had $40,000 of mortgage boot. So they will pay tax to the amount of gain recognized on $140,000. People go, when it's mortgage boot, they go, but I didn't get any money. Does that sound reasonable? I didn't get any money. Why am I paying tax on that? Because what is a loan again? Cash. It just belongs to someone else. So if we look at an example like I like to do when I'm on the phone, I'm going, okay, so you have a loan on your property. I don't have a loan on my property. You don't replace your debt, but I have to spend all of my cash. Is that equitable? Is it fair? No. I said, but we have the same situation, right? Same sale price. They go, I get it now. Can you buy property all cash? It's not illegal, it's just un-American. Okay. Now, when somebody's dropping this far down in value, one of the things that's really important is to determine what would be the gain on the sale of that property if they weren't going to do an exchange. Because the government is coming after what has not been taxed first. So many times people go, well, what about my money that I put into it? Can't I get that back? Not until you pay the tax first. Okay? If the gain on the sale of this property was $100,000 and they have boot of $140,000, other than to give me business, it would make no sense to do an exchange because they're going to pay all the tax anyway. And so these are the things that go along. That's why as real estate professionals, you should get a qualified intermediary in your discussions early on if you're not familiar with how this all works. And it takes the burden off of you, okay? And sometimes you might find out certain things in a transaction that you wouldn't know that can help speed the transaction along or make it, smoother, if you will, okay? Because now the accommodator's coming in and we're talking about something completely different than what you guys are talking about. So is everybody clear on the exchange equation? Equal to or greater than net your sale price. Spend all your cash. Now we can get deeper into that, but I won't, okay? Now, there are certain acceptable exchange expenses and there are some that are not. Escrow, legal fees, commissions, title insurance, qualified intermediary fees, transfer tax, notary fees. Those are all acceptable expenses in a transaction that can be used, exchange proceeds can be used for. What can be a boot issue? Prorated rents and security deposits. So as agents, when you're working with investors and there's prorated rents and security deposits, should you be netting this stuff out through escrow or should you be paying it outside of closing or should the seller or buyer be bringing in the funds? The seller bring in the funds. Here's the thing when it comes to prorated rents and security deposits. If, as a seller, I'm saying, okay, you don't have to bring in another $50,000, okay? Because I don't need it because, you're going to buy the property. I'll not have to give you the money. Has the seller spent, if they're not buying any other property, have they spent that other $50,000? That's the problem. They didn't use up all their exchange proceeds when they go to buy the next property because, okay, you have to use up the money. You have to use up the money. All right, prorated security deposits should be paid either outside or bring in money to cover it. Lenders' fees, points, prepayment penalties, and the like. It's a little gray in the prepayment penalty area because you don't always know how that's going to be looked at when you get the closing statement. Now, here's a call I got today. We have a lender that needs $10,000 for, it's obviously a large property, $10,000 for the appraisal. The bank says for the accommodator to wire the funds to the lender for the appraisal. Can we do that? No. No. It's called the G6 restrictions. We're outside of that. You're possibly blowing your exchange completely. Financing is not an acquisition cost. It's a cost of acquiring, but it's not an acquisition cost of the property. It's not a capitalized cost, okay? So prepayment penalties, loan points, those types of things are not, they're considered boot in an exchange. Lenders' fees, title policy, impounds, property taxes, and insurance, okay? Those are all things that could be considered boot when your clients complete their exchange. So is everybody sort of clear on the points issue? Appraisals, points, that type of thing, that's financing function, not a function of the acquisition, although you need them both to do it, all right? Okay, now, I'm going to intersect right now between the primary residence and the 1031. This is an opportunity where you have, the situations might arise where somebody had a primary residence, they converted it to a rental, or where they have a rental that they're converting into a primary residence, and how these two codes could potentially work together. So I'm shifting gears a little bit on you right now. Is everybody with me so far? Am I losing anyone? Okay, everybody's just wrapped in emotion. Okay. You're thinking you're watching a Star Wars movie. Okay. Okay. People would go and do exchanges in the early 2000s, because that's when I joined. I couldn't tell you what they did before. And they would exchange into single-family homes, ultimately sell their primary residence. And the primary residence tax code, what does a taxpayer get to do? Live in the property, what, 2 out of 5 years? They sell the property, and their gain, if their gain is $500,000 or less as a married taxpayer, they get that tax free. I will use the word free now, okay? Single taxpayer, $250,000. So people were going in and they were doing exchanges, and then they would move into these properties, sit on them for 2 years, sell them, move into another one, let's say sit in it for 2 years and sell them. They were becoming serial home sellers. Okay? So when would you get off the exchange train without paying the tax? You'd have to recapture the depreciation. Well, the IRS got wise on this, and they changed the rules. They said in 2004, for any transaction after October 22nd, 2004, if you acquire a property as a part of an exchange and subsequently convert that property to your primary residence, before you're eligible to get the 121 treatment, the 250-500, you not only have to live in it 2 years, but you have to own it for 5. So you have a mandatory 5-year owning period, okay? So that's how they were slowing the train down, if you will. You have to own it for 5 years. Now, Revenue Procedure 2005-14. This is really a cool one, especially those of you guys that work in higher valued areas. You have a primary residence. Somebody converted it to a rental. And let's say they converted it to a for rental for 2 years. Okay? When they go to sell that property, as real estate agents, you're looking at this transaction and you're going, you need to do an exchange. Should you ever say you need to? No, you should consider doing an exchange. Talk to your tax advisor about doing an exchange. Talk to a qualified intermediary about what the exchange is. But not you need to do an exchange. Here's an example where if somebody had a property as their primary residence, they moved out of it for 2 years, they go to sell it, and their gain on the property is, say, $200,000. And they never used the tax code in the prior 2 years. They can use the 121 tax code, and they do not need to do an exchange because they were not out of it more than 3 years. There was a transaction when this revenue procedure came out. There was somebody was selling in Palos Verdes, and they bought it when there was nobody that lived on top of the hill. The only thing that were there were churches, okay? So the dirt was probably like 60 grand. Okay, now they're selling the property. This was back in 2005 for $1.5 million. It's probably $3 million today, but it was $1.5 million back then. And the guy goes, I'm not too excited about selling the property. You know, I mean, if I get my offer, I'll take it. And I said, he said, because I don't want to pay the tax on because my gain is about $1 million. And I said, okay. I said, how long have you been out of the property? He says, 2.5 years. I said, ooh. I said, there's a revenue procedure that just came out and says, if you have not been out of it more than 3 years, you can do a 1031 with the difference and take $500,000 tax-free at the closing. So in that particular transaction, they had to scramble, though, because their window was closing, all right, on that 3-year period. So what they ended up doing was they took the $500,000 and they did an exchange for $1 million. This is an opportunity where you can use the two. The last use of the property was an investment, and they were not out of it more than 3 years. Okay? That's 2005-14. Now, people have gone and they said, okay, I rent out this property. Whether you got it in an exchange or not, you have a rental property. Say you're getting up in age and you're tired of the 4,000 square foot house, right? You've got this cute little rental. You're going, I can't clean this thing anymore. You know, we're going to go ahead and we're going to sell this property. I'm going to do my 121 treatment, and I'm going to go in, I'm going to move into this property over here that used to be a rental, so, you know, I'm going to move into it. So I have converted it from a rental to a residence. A rental to a residence. Well, the IRS got smart again, to a degree, and they say anybody, is effective 2009 going forward, okay? Anybody that converts a rental to a residence, in order to qualify, you know, for the $250,000 or $500,000 exclusion, you now have to calculate the time that it was a rental to the time that you own the property. So you have a reduction in the exclusion based on the number of years that it was a rental. So it gets a little complex, okay? If the last use of the property is a primary residence, and say 5 years it was a rental, 2 years it was a primary, okay? 5/7, you can have a reduction by 5/7 of that 250 or 500 because 5 years was the rental. Now, if I move out of it and I convert it back to a rental, say for a year, now I can get my full $500,000. It's the last use of the property that dictates the reduction in the exclusion for the 121. Okay, so these are some of the things that are important for you guys to know, yeah.
When you say the last use of the property, is there a time period on that?
Well, when I say the last use of the property, is there a time period? You have to be there at least 2 years to qualify for the 121. Okay, but if you're living in the property, it's your primary residence, so therefore you will be subject to the reduction of the exclusion if it were a rental before. Oh, okay, so the time, if I convert it back to a rental, probably a year to 2 to establish what? That investment intent. So you still have to establish the intent. I wouldn't do it 30 days or six months, but I cannot, and will not give tax or legal advice. But longer is always better than shorter, okay? And then there's the clear split treatment where you have a duplex or a fourplex or something where you're living in one unit and you're renting out 3. This is where you're using the 2 codes together, all right? So is everybody clear on how the 2 codes work together? Exciting stuff, isn't it? Riveting, all right. Now, let's take you through the transaction of the code. How much time do I have? Am I doing okay? Because I'm doing fine? Okay. All right. When you either take a listing or whether you're selling your property, before you make any decisions about whether you should or should not do an exchange, you should talk to your tax or legal advisor to determine what? What is the gain on the sale of the property? Why is it important to talk to the tax advisor? Because as a qualified intermediary, as real estate professionals, you have absolutely no idea what else is going on that client's tax return. There are certain rules called the passive loss rules where you can only write off so much money per year based on your income. And those losses are suspended. And they may have a lot of suspended losses that could be used up against the gain and therefore not have to do an exchange. Here's the deal. If you don't need to do an exchange, you should not do an exchange. That's why you need to go to the tax advisor, okay? Then you go to qualified intermediary, someone like me, because I'm going to talk to them a little bit differently. I'm going to talk to them about the rules of a 1031. You've got your listing going, okay? At some point in time, you have an offer now coming in on the property. Now, here's the thing I would highly recommend for the agents. When you take a listing, and if somebody's going to be doing an exchange, what should you be looking for immediately? You. I like that. I like you. The property they're going to buy, okay? Because we're going to talk about the window that you have to do your exchange. And in this particular market, there's not a lot of inventory. And you can correct me if I'm wrong, but I am like 2 months, maybe 3 months worth of inventory, okay? You're a seller in a seller's market, and now you become a buyer in a seller's market, okay? So it makes it a little interesting. So start looking for that replacement property the minute you take that listing. Okay, you're in contract and escrow. You have to have the qualified intermediary who is assigned into the contract. Remember, I have to be the seller. My documents are going to be the most important thing in that transaction. Am I going to go on title? No. Through our documents, we take what's called equity title, which basically we instruct escrow to deed the property directly to the buyer when the escrow closes. So when you're a buyer, so if you're working with a buyer that's got a seller that's wanting to do an exchange, they're going, well, why do I have to cooperate with this? Why? And here's why. Because when you negotiated that purchase and sale agreement, was I there? Am I a party to any of this? But now I'm being assigned in, right? So because somebody else is being assigned in, they have to be notified in writing of the assignment. Okay, very important. Okay, now, escrow closes. Does the money come to your client? Does the money stay in escrow? No, it comes to me. It comes to me. Now the time frame for the exchange is going to begin. Remember, I told you there's certain rules that you have to follow in order to defer the tax. The time frame for an exchange does not begin when escrow opens. It begins when escrow closes, okay? When escrow closes. You have 45 days from the date of closing to identify, and we're going to talk about the identification in a minute, to identify, and I like to say you have an additional 135 days to complete the acquisition, and exchange in its entirety is 180 calendar days, except for when you're October 17th through December 31st. So if any of you right now have worked with anybody doing an exchange at the end of last year, they don't want to file their returns until they have completed their exchange, because the tax code says the taxpayer has 180 calendar days or their tax filing date, whichever is earlier. And that usually starts getting triggered around October 17th, October 18th, okay? From that till December 31st for calendar taxpayers. All right, so you have 180 calendar days. Now, you have a new RPA, do you not? Item number 26, maybe it's page 9 or 10, I'm not sure. It says the buyer shall not assign. Does it not? Make sure you put in there that this is an exchange, because we have to be what? Assigned into the contract. I don't know why CAR didn't make this where, with the exception of an exchange or something, they could have probably made it a little more friendly, but they didn't. Okay, so make sure that the qualified intermediary is getting assigned, because we have to be assigned into it. Okay, if you don't put it in your initial offering, you're going to eventually have to do it after, but you want to make sure that with the new RPA that you're putting it in probably early on. Okay, so we're being assigned into that. Now here's the thing I always tell agents. As a qualified intermediary, we're working on hundreds of files a day, okay? We don't know where your client is in the grand scheme of things for the buy side, right? And all of a sudden, escrow's getting ready to close, and they go, well, where's the money? Oh, well, didn't we tell you there was an accommodator? So no one has notified the accommodator, right? So now everybody's scrambling because our documents have to come in on the buy side, so we become the buyer of the property, because we're not releasing any funds until we're assigned into the contract, okay? So that money's never leaving our hands until we're into the contract, then we can wire it into the closing, okay? So we're wiring the funds into the closing. Good question. Are we taking the place of an escrow, or are we a part of the escrow? Just think of me as the good little angel that sits on the side, on the right shoulder of the escrow. We're kind of like behind them. Escrow's going to do their job, title's going to do their job, the lender's going to do their job, the realtor's going to do their job, the inspectors are going to do their job, and we're going to do ours. And so we're not a part of, but we come in because we have to be the buyer. So we're not taking the place of escrow because we're not ordering any termite reports or anything like that, okay? We're just there to make sure that, when the funds come in, that's our function, is to be the buyer, ultimately, okay? All right, so does that answer your question? Okay. No, as a matter of fact, I do not take commissions nor referral fees. How do I get paid? We have a fee. Accommodators charge a fee. Yeah, we charge a fee. I like to say the accommodator's fee is the least expensive thing in the transaction that saves the most amount of money. Accommodators fees we can talk about at the end, but they range from accommodator to accommodator, okay? And we're going to talk about accommodators and how you should vet them. Yes?
I got a question about 180 days.
Yes.
You alluding to October date?
Right. Okay, yeah, he's asking about, I was jumping all over the place with the 180 days and the tax filing date, and why I said October 17th. Because the code says you have 180 days or your tax filing date to file. So if I sell a property I close on my escrow, say December 1st of 2014, when am I scheduled to file my tax returns? April 15th. So by virtue of when I'm supposed to file my 2014 returns, which is going to be April 15th of 2015, my time frame is shortened unless I file an extension on my tax return. Okay, so does that answer your question? Exactly. That's how you get the benefit of the full 180. And here's the thing. Hopefully, if somebody walks into, there's early filers, okay? They're at their accountant's doorstep on February 1st because they got their W-2s and everything, and they're ready to go, okay? The A-type personalities. Okay, I'm ready to file my return. And then so they're there with their tax advisor, and they're looking at all the closing statements and such from the sale. Hopefully, their tax advisor will go, well, wait a second, where's the closing statement for the buy? And that will stop them from filing the return. If you file your return and don't complete your exchange until after, and there's a court case called Christensen versus a commissioner, which I'll highlight on, you've blown your exchange. There's nothing you can do about amending it. You have to extend it. Okay, so once you've filed, you're done. Okay, so does that answer your question? Okay. You only have to worry about that in October. Middle of October to the end of December for calendar taxpayers. Okay, now that's the flow of the exchange. The 45 days, you have to identify the replacement property, and again, the 180th day you have to complete. These are calendar days, by the way. I can't tell you how many times where people go on vacation in the middle of their exchange. Ooh, don't do that. Not a good idea. All right? Okay, now let's talk about the identification. There are 3 rules that a taxpayer gets to choose, but they only get to take one of the 3. They have 3 to choose from, but they only get one. The most common rule is the 3-property rule. The taxpayer can identify up to 3 properties without regard to fair market value. They're limited to 3. They do not have to buy all 3. They do not have to buy all 3, but they have backup, okay, in case something goes awry. Now, if a taxpayer wants to identify more than 3 properties, they're given an opportunity. They will default, as I like to say, to the next rule, which is a 200% rule. They can identify, in that particular case, using the 200% rule, more than the physical number 3. So I might identify 5 properties, or I might identify 10 properties. But I have to add up the fair market values of those properties, and it cannot exceed 200% of what I sold. So if somebody is selling in Orange County, and they're buying in Orange County, I assure you they're not going to use the 200% rule, just by the value itself. Now, we had a transaction for $1.4 million coming out of Newport, and they identified 30 properties. 30. They were not buying here, okay? Georgia, Missouri, Ohio, okay, where you have smaller valued properties. They can identify up to like $2.8 million for smaller valued properties. So it all gets down to geography and to the price as to what rule you're going to use. Now, there's the 3rd rule, which may seem really sexy in the beginning. It's a 95% rule. I can identify as many properties as I would like without regard to fair market value, so I don't have that 200% ceiling. You're going, whoa, well, why doesn't everybody use that rule? Because you have to acquire 95% of the value you have identified. So let me help you out. You have to buy your entire list. If you do not, if you step down from that list, you will be taxed because you have not fulfilled your identification. Here's something to be aware of, and people think that it's the 45 days and the ID rules are suggestion. I don't know about you, but orange is not my color, okay? It is not a suggestion. These time frames and these rules are statutory. They're statutory. You can only buy what you identify within the identified period of the exchange. I had a broker call me up and said, well, what if my client just changes out their identification? You know, switch the old envelopes on day number 75. Cannot do it. Because now the client's going to be signing their tax returns, are they not? And when you fill out the 8824 form, on that form it says, when did you identify? They were thinking about saying, and also with whom, okay, but they didn't. When did you identify? So if you say, I identified within the 45 days, and then you get audited, and by the way, the FTB is auditing, and they've got some people on this one, okay, and they disagree with you, you not only have a taxable event, but what have you just done? Say it with me, tax fraud. Tax fraud. There's somebody up in the Sacramento area back in 2010 that served 3 years in jail. Okay, it could be 3 to 5 years as the penalties. So planning, planning, planning. Very important, okay? You can only buy what you identify. Yes, ma'am? Okay, the question is, in this situation, to try to avoid all these headaches because you're in a seller's market and you find, basically, I'm going to paraphrase a little bit here, you find a suitable replacement property where you feel comfortable that you can do with your ID, can you do the exchange, in effect, in reverse? And the answer to that is they are available. Whether they're doable or not is going to be a transactional question. Because now it gets down to, when we talk about, it's called a reverse exchange, or better known as a parking arrangement. Okay, when you do a reverse exchange, okay, the taxpayer is not on title to the property they're buying. The qualified intermediary forms what's called an exchange accommodation title holder, an LLC, and we physically park title to the property. So we're going now on title to a property. Now my question to you would be, where are you getting the money to buy? The accommodator? But in the meantime, okay, but in the meantime, you have to close on this property, right? Because the reason you're doing a reverse is because you're closing on the property. Now, if you're asking, can you be under contract on your replacement property but not closed? That's totally fine. Just watch those dates and watch any contingencies. Okay, because if you've got certain dates where you're negotiating and you're saying, okay, well, I'm going to tie up this property here, and you have a willing seller, and they say, well, wait, but you have to wait for my closing, that's not a reverse. That's still a forward exchange. But if the seller's not willing to wait, because maybe the seller's doing the same thing, okay, you got a little daisy chain of activity going on here. So the seller goes, no, you got to buy it now if you want it for this price. So my question is, where am I getting the money? Because nothing is sold. The accommodator? Perfect. What if I have to go to a lender? Problem. Okay, if I have cash, piece of cake, because you're lending me the money, I'm going to give you a promissory note. We're going to form an entity where we're going to park title to the property. We're going to go out and we're going to be sitting on title to this property. You still only have 180 days. When that property sells, we're going to pay off that promissory note with the cash coming in. That's easy. Where it's not so easy is when you have to get financing. And if you're going to like Chase or anybody else, they're going to say, well, we'll lend on this all day long. And I'm going to go, no, I need to talk to your lender. They go, no, my lender told me it was fine. I said, your lender, I need to talk to your lender. And he goes, no, but my lender said it's okay. I said, does your lender know that we're going to form a single member entity that's going to sit on title to the property, and there's about 10 sentences that's going to say you have to insert in your loan documents, because we're signing your loan documents, by the way. We're not guaranteeing your loan, but we're signing them. And even if there's non-recourse financing, there's always going to be bad actor language in a loan. Are you going to change your loan documents for us, friendly lender? I didn't change my loan documents. I didn't think so. Okay, so it gets down to, if you have the cash, it's really simple. Okay, or if you get to a portfolio lender. When you talk about these kinds of exchanges, I can talk about this like 3 or 4 times a day, because people are looking at what's my options. And that's what I said, they're available, they're not always doable, because people don't always have the cash because they need the cash from the sale. The other aspect when we talk about reverse exchanges, at least when I do, I'm running the numbers. What is your tax if you just sold and didn't? Because to do a reverse exchange is 10 times more expensive than it is to do a forward exchange. Okay, so I don't want to go too deep into it, but it is available, it's expensive, and it's right for it's good for the right people at the right time. Okay, but it is an option. All right. Sure. Yeah, hard money. Yes, but when you're thinking about the hard money as an option, you have to consider not only the qualified intermediary's fee for doing what we do, but now the cost of the loan, which is going to be several points. And then, depending on where the property is being parked, if you're in LA, what is the transfer tax in LA? Where's my title people? They left. Transfer tax in LA, about $4.50 per thousand? Something like that? Okay, the seller may pay the transfer tax going in, but who's going to pay the transfer tax going out? And if you're talking about a $3 million transaction, that can get pretty hefty. So that's why we run the numbers. So you have, when you talk about that, you have to consider the cost of doing it to the cost of the tax. Now here's the beauty of a reverse that very few people talk about. When the qualified intermediary forms that LLC and we're sitting on title to the property, we're master leasing this property to you. You're going to deal with the tenants, the toilets, the trash. You're dealing with it all. We're not dealing with any of this. Now the beauty is you have income on two properties at the same time, where when you're doing a forward exchange, you don't have income on that property anymore after you've sold, have you? So when you think of the economics of a deal, the closer you get these closings together, the better. I got this one call all the time. Well, who's going to give me money for the rent I'm missing after I sold the property? I said, is there Alan Funt here for those people that know who I'm talking about? Is this candid camera? Not me. You know, people lose when they sell. They no longer have that income stream. See, people, you know, they forget about the economics of a transaction. So the closer you get your sale and your purchase together, the more continuity you have going in the income stream of ownership for investment property. And that's, like I said, that's the beauty of the reverse, because you're going to have both of the incomes at the same time, okay? But it's expensive. It's very expensive, okay? All right. Okay, so everybody understand the rules? Okay, now, the ID must be in writing. It must be unambiguously described. It must be delivered, mailed, telecopied, or otherwise sent by midnight of the 45th day. I liken it to Cinderella at the ball. After midnight, the pumpkin, the coach is now a pumpkin, the horse is now rats, and she's in rags. Midnight is the drop-dead day. That's it. Whether it's a Saturday or Sunday or a holiday. If your client sends the qualified intermediary the identification form, and they get in on Monday and they look at it and you've got it wrong, there's nothing that can be done. Okay? It's locked in. Always a recommendation. Now, you as real estate professionals, should you take that identification letter? Say no. You are an agent for. You cannot accept the ID. Can you poke, prod, aggravate, annoy, remind? Okay? Yes. Because the 45 days goes by really fast. Really fast. Okay? All right, so you want to make sure that you're there. We do not take DocuSign. Okay? No DocuSign in my world, at least with my company. I can't speak to other qualified intermediaries, but it has to be signed. Now, we've had an identification letter that was signed on the beach of Mexico, pictured with their ID and sent in, because it can be faxed, right? So that worked, but it has to be a signature by both parties. If it's two people, then it's signed and dated, okay? So that's how it has to be sent. So everybody clear on that? Okay. Now, what not to do in an exchange. Christensen versus the commissioner, okay? They filed their tax returns without completing their exchange. Their exchange was invalidated. Then there was Knight versus the commissioner. Their transaction closed after the 180th day. Didn't work. And then the kiss of death is Dobrich versus the commissioner. Dobrich versus the commissioner is a 1998 case, by the way, in the Northern California. Seems like everything comes out of Northern California. Okay. They backdated their identification letter, okay? Fraud was assessed. They managed to talk their way out of jail, I believe. The agents didn't get caught up in this, but was probably a good thing for them. They were assessed a 75% penalty. It cost them $1.7 million. So as I'd like to explain to agents, and there are accommodators out there, and I'm going to tell you I'm not one of them and I lose business for it. But as a company, we've facilitated well over 150,000 exchanges nationwide, and we are not about to put any of those exchanges at risk. Because when you start accommodating accommodators, then you can be looked at, and all the exchanges you've worked on, worst case, could all be invalidated. We just don't go there. Okay, that's not what we do. Our fee is too little, okay, to worry about tax fraud. It's just not going there. But I know how important it is for the clients to go, and I don't want to, I don't want to lose my exchange. I don't want to pay the tax. So timing and understanding the timing and getting that across is very important, okay? All right. Now, A couple of things just to bring up as we're coming to the, wrapping it up here. The state of California passed a law, AB 92. There is a new reporting requirement effective this year. If somebody a California resident or somebody had property in the state of California, did a 1031 exchange outside of the state of California, there is a form that they have to fill out. It's an FTB 3840 form. It's an information return. If the taxpayer fails to do that, the Franchise Tax Board can assess the tax that they might have owed the state.
If they own it here, but they live out of the state?
Same thing, if they're exchanging out of the state. If you're going out of the state of California. So if I had Orange County property and I went to Texas, okay, I have to file an information return as long as I own these properties, okay? Because it's called the clawback provision, and it's nothing new. The state of California just had no way of catching you. Now they do, okay? So that's very important to know. Audit issues that we're seeing, boot. Okay, not reporting the boot properly. The G6 restrictions where the taxpayer has access to funds and they shouldn't be having the funds. The relinquished property and replacement properties were not held for investment purposes. Okay, the taxpayer transfers relinquished property is a different form than the party who acquired the replacement property. Same taxpayer selling needs to be the same taxpayer buying. Very important. The qualified intermediary, if you're working with a firm that's paying attention to these things, we're going to catch it. There was a qualified intermediary that let somebody sell as an individual and buy in a partnership. Never brought it up. Now, whether they're liable or not, the courts will decide, but where are they? In court. Okay. And drops and swaps, and I think I've already mentioned that. Okay. Timing, planning is very, very important when you have partnership issues. Now, let's see. In 2014, Bacchus and Camp were proposing to eliminate 1031 tax-deferred exchanges. So I'm getting on my little bandwagon right now on this one, okay? Do you see how valuable 1031s are, okay, for investors that want to stay invested in real property and use that money to buy more to grow their portfolios, okay? All right. But the government seems to think that this is a nice little way to get more money. They think they're going to get about $98 billion if they eliminate exchanges. Well, the Bacchus and the Camp bill, now the reason our industry is concerned about it this go round is because you have a Republican and a Democrat both wanting the same thing. Okay, and when that happens, generally speaking, that's not a good sign for the taxpayer, okay, especially in this particular case. Now, they had that went away. Now the Ways and Means Committee is revisiting budget reform. 1031s are on the table for budget reform. Now, President Obama, in his budget, talked about also, whether it gets passed or not, I don't know, but he also talked about increasing capital gain from 20 to 28%. Okay, 20 to 28%. He also talked in his budget about eliminating, you ready for this? The step-up in basis. No bueno, okay? Not good. All right, so it's important for investors, real estate professionals, and the like to make your voice heard, okay? There's a website, www.1031taxreform.com. You can send your letters to our senators or Boxer and Feinstein, whoever your House of Representative is. Let your voices be heard. I've seen letters from Elizabeth Warren. Does everybody know who Elizabeth Warren is? Okay, she's senator from Massachusetts. And her letter said, the tax code should reflect our values. I'm not sure how that plays, but we need to get more revenue for infrastructure. And then she also used the word, it should not be a loophole for the wealthy. Now, what is a loophole? Is a 1031 a loophole? No. A loophole is when a certain segment of people can benefit from an aspect of the tax code. Anybody that has investment property that follows the rules and goes with the, with the time frames and everything are available. This is not a loophole. This is a legitimate part of the tax code, and it has been since 1921. Okay? It's been around for a very, very long period of time. Make your voices heard if you want me to still have a job. But you want to talk about season an industry down if this thing goes away. We don't know what's going to happen, but we are, we have a lobbying arm that's doing this. And then last but not least, when you're dealing with a qualified intermediary, remember, we're not just documents, we're holding your money. So the security, the expertise that you're working with is very, very important when you're dealing with a 1031. It's not just paper that we push, we hold your money. And in our industry, we're holding billions of dollars, okay? So with that being said, I think I'm getting the hook, almost, okay? So anyway, any questions? I answered them all? Gosh, all right. With that being said, I hope the information was beneficial. You've got my card there. If you have any questions, please feel free to let me know. Thank you for the opportunity.